So what we had to do is actually we moved to borrowing less money. So we went to like a 50% borrowing limit, leverage on those. And then we were still buying 7, 8 cap deals that still had us hitting our rough cash on cash numbers there. We just borrowed less because it was expensive money.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. I've had a few programs about mailbox money and how to create massive passive income so that you can become one of the wealthy folks that are able to make money while they sleep, right? That's what real estate is about. You're putting your investment into an asset that you have limited risk in for a high reward. Kenny Wolfe, our next guest, is a master multifamily syndicator. I love having folks like Kenny on. One particular reason is he started investing in multifamily in 2010. And so I know there's folks that listen to our program that are just starting out. And I think it's important for you to know that 10 years is a good amount of time to be obsessive about this industry and your growth. You don't want to start off on the wrong foot. When you start, you don't want to stop. And Kenny is one of the folks that did that. I like to model my career after the folks I have on this program and my mentors, and it keeps me sharp. So a lot of the past interviews I've had are about, hey, how do we deal with this inflation? What's going on with job growth? What's the Federal Reserve doing with interest rates? And I would love for you to check them out. Most of my questioning is about how and what we can do today to have prudent investments in the future. I ask everybody to give me their crystal ball view of what they see happening. I hope that it helps you in what you're doing. I have a bunch of awesome tools on our website, rei.mba, to help you invest. We have a financial calculator to help you underwrite your multifamily deal. We do webinars, and we have a roadmap where we've organized all of our podcasts through stages of the real estate investor growth. From, when you don't have any real estate, how do you package yourself up to be able to go to a bank, all the way to syndicating real estate and how to fundraise. Or Gene Trowbridge, great interview with him on how to keep everything legal when you want to syndicate, right? No one wants to go to jail, and we spend a lot of time to be prudent. And the SEC is a very serious thing. So you may as well do it right for your investors. Important thing I try to teach to everyone that I work with. So Kenny Wolfe is an experienced multifamily investor, the founder and CEO of Wolfe Investments, and published author of Investing in the Dream: How to Acquire Multifamily Real Estate and Attain Total Financial Freedom. He invested in his first multifamily property in 2010 and instantly saw the potential for real estate to transform his life, giving him the opportunity to quit his day job and start a company. Kenny is passionate about helping others attain financial freedom through real estate investing. He believes in the power of passive income, making money while you sleep, and encourages others to think beyond traditional investments to grow their wealth. Kenny has been involved in over $450 million worth of commercial real estate transactions nationwide and is a principal in 5,000 units. 7,000 units is the all-time high. It's amazing. He holds a bachelor's from Baylor and an MBA from the University of Texas at Arlington. He resides in Texas with his wife, daughter, and son. When he's not scouring the market for new deals, he enjoys discovering new vegan restaurants and rooting for the Broncos. Amazing guy. I hope you enjoy the interview. And check out our website, rei.mba. Cheers. We got Kenny Wolfe today. Kenny, thank you for being here. Appreciate the time.
Absolutely, Tejas. Good to be here.
For sure. So you have been busy. I just did a long-winded introduction about you. Just for our listeners, can we get a high level? Who are you? What are you doing now?
Sure. Yeah. So I started Wolf Investments in 2010, over 12 years ago now. We started out in existing multifamily. We still do that today. We're in 4 different states right now on that. And on top of that, 6 years ago, added 2 arms. So we now have a triple net fund. Our funds, we're on four. We just wrapped up fund number 4 with almost 60 CVS, Walgreens, Dollar Generals. And then we also do development of multifamily, so both ground up. And then in that same arm, we have 9 downtown office buildings we're converting to multifamily in under development at the moment. So we have a pretty wide.
What downtown?
So we are in all over the country. We're in Cleveland, Atlanta, Dallas, Fort Worth, Columbus, Ohio, and Atlanta, Georgia. So we're kind of all over on those.
Bravo.
They're great projects.
That's great. That's some heavy lifting to get, right to where you are. 4 funds. Interesting. I manage 1 fund, and I love the fund managers that figure out a way to capture as much as possible and create a vehicle behind it. So let's get into the CVS. How are you pulling that off? It's got to be a hefty amount of capital, and then probably some specific investors that are putting in large amounts of capital. Can we talk about that?
Yeah, sure. So those 4 funds, we do a fund every year, and so it's for folks that really want that monthly stable income, that cash flow. Because there's no better mailbox money than those CVS, Walgreens, Dollar Generals, because they guarantee the lease and they take care of 95 to 100% of the operational expenses as well. So it's so smooth as on that front. We have 56 stores across the U.S. right now in 16 different states. We have enough now. We had to create our in-house management of those as well. So there is, while it is a lot of mailbox money, there is some management that you need.
Of course.
And then this year we already have a family office that wants their own fund. So that'll be, they're dropping in about 15 million of equity on their fund. And then we'll launch our other fund here in a couple of weeks with, for our investors that are on, approved. We already did the phone calls, all that fun stuff.
These are all accredited investors?
So obviously the family offices, but on our typical fund, in all of our investments, we take both sophisticated and accredited investors. We do 506Cs.
Oh, bravo. My favorite thing in the whole world.
Absolutely.
Gets you to really use the power of the internet and create opportunities that none of these people would have ever seen.
Exactly.
Which is very cool. So triple net leasing. Let me act like I have no idea what that is. Can you explain it to me from the root? Why would an investor really want that?
Yeah, sure. So, and then brokers like to overuse triple net. So I'll tell you the exact, what it means, and then we'll talk about what they sometimes mean. So triple net means that, so if we have a Walgreens we bought the Walgreens in Kentucky. They're one of the ones in Kentucky, Franklin, Kentucky. And we walk in, well, the roof is leaking. We looked on the lease before we buy it. No, so Walgreens is on the hook to replace that roof, right? And so I was like, absolutely, we'll buy it. The tenant Walgreens, and it's a publicly traded company. That parent company guarantees the rent, so you're going to get that. But they take care of all of the operational expenses, 100%. So they do the landscaping. They reimburse you for property taxes and insurance. They fix the roofs and the toilets and all that kind of stuff. So an investor really buys those because they want monthly income with very limited headaches. That's why they do it. The downside to those is that the rents don't reset every 5 years, maybe 10 years, right? And so you're not going to capture as much appreciation compared to our multifamily assets. So it's a trade-off. You're in it for this monthly almost fixed cash flow.
So let's talk about the cash flow. Triple net, from a realtor perspective and a fund manager, it is a lower return, right?
It can be. We have a little bit of a secret sauce, is what I call it, on how to juice them. But we're hitting about an 8 to 10% cash on cash return
on triple nets.
Yeah, come on, Hayden. Let's go.
Fantastic, man. Like, because I'm used to like Wawas and other. Actually, we had a CVS, and we're trying to sell it at a 5 cap, and
Right.
trying to like suck out cash flow with these interest rates and stuff.
Right.
So how do you do that?
Well, so this year we had a pivot, right? So in March, April, the world changed in lending this year, or sorry, this year in 2022, I should say. We're in 2023, last year. And so what we had to do is actually we moved to borrowing less money. So we went to like a 50% borrowing limit, or leverage on those, and then we were still buying 7, 8 cap deals. And so they still had us hitting our rough cash on cash numbers there. We just borrowed less because it was expensive money. And the thought process is a couple we just paid cash for. The thought process was to refi them there in the next 12, 18 months when interest rates come back down again. So really that's kind of how we navigated 2022 on those.
And so we're talking about one fund, triple net, good returns. In my head, I was saying like you trade off a 12 cap or all these bigger, different, more riskier returns for a extremely secure company that almost has zero risk if you're looking at it the right way.
Right.
But you're getting a very clean asset too.
Right.
It's easy to want to invest in something like that. And folks in that fund, they're in it for the long haul. They're really kind of just hedging their bets.
Absolutely. And that's our, I had the need from our investors because, before that, I was known as the multifamily guy.
Yeah.
So that first fund was like pulling teeth because they thought I lost my damn mind by doing, we bought $7 stores that year, and it was like pulling teeth. I think we only raised $1.7 million for that first fund because it was something new. Like I had to educate them on, they knew real estate, they knew cash flow, but it was like, why would you buy a Family Dollar, And so now it's really ramped up. We raised almost 20 million last year's fund of equity. So it's now we have family office and all that stuff. So
Pause though. When was that you made that transition, that shift, and educated everyone?
2017. So we were, I started out in multifamily 2010. So 7 years ish, going on multifamily. And then, oh yeah, we're doing multifamily and triple net now. So,
Sure. Thank you. Sorry to continue, but thanks for that. It's good.
yeah, sure. Yeah, so that's kind of where we kicked off that fund, and and then now we've expanded. Now we have corporate Verizon stores, Advanced Auto Parts, Walgreens, CVS, like I mentioned. We have one LA Fitness down in Florida. So it just kind of we've kind of expanded our tenants, which is also good.
So I gotta ask, what about if one of those tenants leave? What are we gonna
Sure.
do? That's
Well,
kind of
I
like
actually have 5 examples. They've always renewed. So we finally got our notice from a Walgreens last week that in 2.5 years they weren't going to renew, which is really early. Usually they give you like 6 months, right? Notice. They were like 2.5 years. Like that's some
wow.
planning.
That is
Right there.
lucky.
But what they offered was to pay us 95 cents on the dollar for the remainder of that term, just to cancel the lease now. And so right now we're running around looking for replacement tenants. Right now we're calling Dollar General, Family Dollar, Dollar Tree. We also have Ace Hardware. They love vacant pharmacies to fill those spots. So we know kind of who to fill what spots with. And so it's a town of maybe 2,800 people, 3,000 people. It's a smaller town. So maybe an Ace, maybe a Dollar General would be great there, or Dollar Tree. They don't really have one there.
It's kind of cool that you got the buyer pool already. It's in place. You don't have to wonder, and they're taking you seriously because you own a bunch of these properties already.
That's true. Yeah. And then, I mean, if you think about it, so, I mean, they're going to give us, 95 cents. They're going to speed that up. So if we find this replacement tenant, and they're ready to sign a lease, we'll say, absolutely. They're going to pay us like 450 grand, something like that, to get out of this lease. Well, that's a huge windfall because I think we only put in like 300K of equity out of that fund. So we're going to double the equity just by speeding it up. If we can find that replacement tenant quickly, who their cash flow will start, very quickly thereafter. So it'll be a win-win when you can fill those spaces for sure.
That's brilliant. It's the way to go. I'm sure your lawyers or yourself are just hammering away at those lease terms to figure
Yeah,
out because that's kind of the tough part. There might be a Satinder or some other triple nets that you got to get knowing that they might go out of business. Not out of business. I'm sorry. Maneuver their
sure. Close down a store or whatever. Yeah.
yeah. Let's talk about some of your other stuff. So like multifamily shifting into all of this. That's a massive education, and then like just risky. I mean risky in hey, I'm going to go do this new thing that's
Right.
so established, and all these other people are doing it. Because it's cool, right? I love their show because people They like the transition, the level up, and to be able to keep going. I'm certain you're a systems guy. You're keeping everything legal. I think that's what most people are afraid of. Like, how do you do all this? How do you keep it clean? How do you keep it legal?
You have a great SEC attorney, so we've got a great one, Gene Trowbridge. He's done all.
Oh, Gene's been on the show.
Oh, you know Gene? Okay,
I've
good.
had I've had 3 with him. He's my favorite guy in the world.
Awesome. Yeah, he's one of mine too. He's we're his second. We're number 2 on PPMs with Gene all time. So he says the number 1 folks are. He's about 92 years old, still doing deals. So maybe I'll catch him someday. But I'm number 2.
That's amazing, man. But yeah, you need people like Gene. Gene's actually not a hard person to find, but a difficult person to work with because it's not easy to come up with this. A lot of people have this concept, this idea. They're kind of what's the word? They're underdogs, right? They want to go get this documentation, attach it to this $20 million property, and go to market. How'd you pull that stuff off in the beginning? Like
Sure.
data, you've been collecting clients, friends. How'd you do that pivot? And you mentioned the first fund was tough to get some capital for. Now you're at 20 million. That's a very short. That's 6 years, right?
Right. Yeah. And
Talk
we should.
about that. How the hell did you do it?
So yeah, the triple net, we had a pretty good following already from our investors. So it was really just, we bought tacos a couple times throughout the year and invited them to learn about triple net investing. I've got a YouTube channel. I put out some videos on triple net investing because there's really not a lot out there on those, really, not in a big way. So really it was that, just kind of getting the name out, calling folks. And then once that first fund for anything, whether you're starting off or starting into a new different asset class, it's going to be harder because folks just need to see proven results, right? So you're going to have to. So once our investors start seeing the first investors that took the leap with us start seeing the cash flow, and we can kind of point to that. I mean, the second fund was, I think, almost 4 million. The third fund was 10 million. The fourth fund was 20 million. So it keeps doubling, right?
Yeah.
So that's. It's just slogging on out, getting those first few investors, and then proving the model up, and keep going.
Yeah, and building it right. The timing is really difficult. You have a preferred and quarterly returns, I'm assuming.
So so that kind of differentiates us. We don't have a preferred return on any of our offerings, and we don't do an acquisition fee on our multifamily or our triple net development. We do because there's a lot of upfront legwork. But anyways, for multifamily and triple net, there's no upfront fees. There's no preferred return. So it's just a split of cash flow and a split of cash flow of refi because we are a longer term hold company. And so I wanted to make sure that we're always aligned. So by delaying my gratification on an acquisition price and then them getting a pref, and make sure that we're both on the same page of trying to get this thing to cash flow as fast as possible and to refinance those as fast as possible as well.
Love it. Entry, exit, do it right all the way through. How about let's come up to speed. The interest rates, inflation, wars, literally everything that could have gone wrong has gone wrong. So what are you doing now? Are you looking for new projects? What are your investors are hungrier, or people, because I've noticed, some people hate the stock market now. They loved it for the past 20 years. They hate crypto now if they've lost a bunch of money.
Yeah.
What's going on with all that?
So it depends on the asset. I mean, so we still have a B class value add in our pipeline. It's actually a portfolio here in Texas, 443 units. So we're still buying that here in the next couple of weeks, wrapping that up.
Congratulations.
Thanks. And then we've got probably 3 more office towers in downtown locations to convert. Those are really ticking up. Some of those we're buying outright. Some of those the office owners we're doing a joint venture with them to make it a win-win. So we're doing that. We're seeing a lot of that tick up. Ground up, we're still doing that as well. And we've just been pretty busy. I mean, we haven't had a break all through the past 2-3 years. Just keep finding new deals to invest in. And that's what's nice about being diversified on what different assets we look at. So we're always busy up here at the office, so, and then investors, you're right. I mean, I just had another conversation, I think last week, with a new investor, and they were just tired of the stock market. And so they want to find something else that's real. I want some cash flow. I want some appreciation. And so we kind of talked through which option would be better for them and their family. But yeah, I mean, there's a lot of folks who are getting fatigue of the stock market. They're getting fatigue of crypto. And they just want to rebalance their portfolio, which is always smart to do, to
Yeah.
diversify it for sure.
It is fun to see the shift, and now it's like you got to be tangible if you're going to be taken seriously. You can't be this like, I mean, I love the FTX stuff. I hate it, but like I love it because it's like none of this is secured. This is not, there's nothing secure about any of this. Real estate is the most secure part of this. And there's so many more people looking for that. It's a big turn. Everyone's like, oh, I'll make money in crypto. But now it's like, okay, I need the stability of real estate. Where are your investors from? Specific areas, nationally?
We have a few international now, but we have, I mean, most are from, I mean, we're based in Texas. And so a lot of our here, California, New York, kind of your typical, where most of the money's found. But really, I mean, we have folks from Ohio to Oklahoma. I mean, it's just all over for investors now. And I mean, like I said, we've got a few international folks, Philippines, Switzerland. I mean, kind of all over now too. So a few of those are starting to tick up. And I think partly is that YouTube channel we've got going on now. So that definitely helps with the reach.
Which is awesome. It's in the show notes. You got to check it out. Kenny's all over the place, which is wonderful. How about some crystal ball stuff? People, I have a lot of first time listeners that are always on the edge. And, some of those folks are like years on the edge. And it's like, all right, next year's year, next year's year. And then this stuff happens and they get discouraged for another entire year.
Right.
What do what are you doing for the future? Can you give me any encouragement?
Yeah, absolutely. I'm probably the bullish person on that might be on the show. We're still buying multifamily because we have a 3.6 million housing unit shortage across the country. 3.6 million, and that deficit grows every single year. And now some states are better than others, some cities are better than others, so you need to keep that in mind. But as a whole, we're way short on housing, and there's no way for us to build enough to keep up. When you build, so we are so developers, you have to end up with an A-class asset because land costs too much, material and labor all cost too much to do a B, like a working class, or below, asset. So we already have like this fixed fishbowl B and C class, right? There it is, fishbowl. But they either, with more and more fish going into it, and then sometimes we'll tear down a B or a C class asset to build an A class. So it's either, you have the same amount of supply of workforce housing in the B and C world, and or going down, but you have ever growing demand for that B and C class. We still buy A class. We love it. Rent growth has been off the charts, from A class all the way down to our C class stuff. It's been double digit, and that's either in Amarillo, Texas, Longview, Texas, Oklahoma, Cleveland, Columbus, like wherever we're at, we're still seeing, and still to this day, like we're still seeing double digit rent renewals. I'm not even on brand new units. It's good. It's insane how much this inflation has actually helped us, on the owners, on the real estate side. Interest rates actually have been a pain. You can't deny that. But with the interest rate or the rent growth outpacing the interest rate issue, it's really not that bad. And at the same time, I've now heard of two people, but for the vast majority of folks that had those bridge loans that had, a floating rate, I know on all of our stuff, we were doing a lot of bridge, but we also bought rate caps. And so
Mhm.
all of our rate caps have kicked in. So yes, we're cash flowing a little lower than I would have liked, because of interest rate up, but the damage is minimized because we have these interest rate caps where, if the interest payments go above that rate cap, which they all have now, the insurance company that insured that is paying that on my behalf, right? And so so you have to limit your exposure. You have to look at the downside for sure, and plan for that. But you can't sit on the sidelines because you won't enjoy the upsides to some of these sales we've had. I mean, we sold a deal last year, owned it for 13 months and doubled investors' money.
Wow.
And that was, so we bought that in 21, like, COVID was still around. No one knew what was going on, and all that. And then, so if you sit on the sidelines, you're going to miss out. I mean, there's
Mhm.
never my great grandmother, told my girlfriend, now wife, the first time she met her, that it's never a good time to have a baby. That's what she
Yeah.
told me. So it's kind of like that. It's never a good time to, and it's never like the perfect, stars
Sure.
aligning time to invest. You have to look at it, judge it, and then there's risk to it. So you got to take a little bit of a risk. I mean, but you have to balance that out with the returns too.
Love that. Thank you. Two quick things. So you getting the rate locks. I love calling it one of those I was right moments.
Right.
I was right. Investors must love that, you're hedging bets. So great, cool. Just wanted to point that out. Second part of it, housing, right? I'm gonna act like I don't know. What do you mean this deficit of housing? How long has that been going on? Were we in a surplus before? What can you explain what that means for
Sure. I mean, I think even up until '08, we still had a somewhat of a of a shortage. But '08 really rocked the world of development. It just ground to a halt. And so there was, you still have that growing demand. People are still having kids. They're moving out from home. They're graduating college. But basically, you had a 2-year freeze on development from '08 to 2010 for the most part. And we've never caught up from that. If you look at the charts, I think HUD has a great chart on that. But if you look at the charts, it kind of ties back to '08 and that big downturn that just basically, squashed 18 months, 24 months of new developments. And that really hurt that. And we've never really caught up. Even how much we're building, last year or in 2019, 2018, all that, we were still running a deficit as to what the demand was. So it really kind of, it's put us on an interesting path. And I think that's partly why you saw single family housing jump up so much, is because the rents were so high. They just kept climbing because, the country was 96% occupied across the board in June of last year. I mean, that just tells you how much demand. That's nationwide again, but still, there's so much demand. Our properties are so full of residents now.
and that's for renters, right? Because they can't find a place. If you want to explain that a little more.
Yeah, sure. So, I mean, we've had folks where we've increased rents 10% to what the market is. That they get a little mad when they get the letter. They walk in and vent a little bit to our poor managers, but then they go out, look around town to see where they can move, and they come back hat in hand, said, "Okay, I'll take the deal."
Yep, yep.
Because they know, one, it's going to cost a lot of money to move, and it's a pain. No one likes to do that. But two, everybody else had jumped their rates up by 10%, 11%, whatever it was, right? The market. But so folks kind of have realized that, I mean, if they've got a lease and it's only going up by 10%, you take the deal, because otherwise it's going to be a new rent and a new lease, and it may be higher.
Brilliant. Yeah, yeah. Good metrics. You think we're gonna catch up one day?
I don't think so. I mean, you'd have to. So again, you can only build A-class stuff, right? So because of how much it costs and everything, and so really the A's just eventually turn to B's, eventually turns to C's, but that's 10, 15, 20 years down the road from when that A-class is built. And sometimes they never turn because they just keep getting better and better depending on their location. So for B and for the middle class, I think they never catch up on having enough housing for that. Just because you have to build A-class. There's no other option.
We're coming to time soon, which I hate, but fund managers or folks that are in commercial real estate that do some heavy lifting, it's like you're like kind of manic all the time. It's like you're thinking about this data and demographics is good. It's like a big
Oh, yeah.
buzz and it's healthy. It keeps you up or keeps you motivated. How do you stay motivated? You've obviously done so much. You're younger, and then like family, friends, like what keeps you moving?
Yeah, so we crossed the 665 million of assets under management mark here at Wolfe Investments, and so
Congrats.
the goal was $1 billion by 2029. But with these office conversions coming on, they're pretty big projects. We'll be at $1 billion probably by end of 2025 of next year. So
Congratulations.
yeah, thank you. That's the big goal. It's always been the goal. So now I need to reset the one for 2029. But really, and also too, it's our investors. So you had one of those kind of, or a few of these now, career changing phone calls where got a call from one of our investors. He said, "Kenny, I can now check the accredited box because you've helped me get to that $1 million plus net worth." I wasn't the only syndicator that he was working with, but it was nice to hear that. Thank you.
So, Kenny, you're a super busy guy. It is difficult to stay motivated. Fund managers are always kind of nutty and thinking about demographics and what's the next piece of real estate asset management. Like you actually think about specific tenants. How do you stay motivated? How'd you, just keep it up?
Sure. Yeah. So we're at 665 million of assets under management now here at Wolfe Investments. And we had to, we used the EOS, the traction, the system, like, so from Traction, a book from called Traction. Awesome job, awesome book if you're a business owner. But anyways, it guides you on how to grow your business, and it gives you, sits you down, makes you set big goals. So our big goal, or my big goal for the company, was to hit $1 billion of assets under management by 2029. I think we'll hit that by the end of 2025. So we're way ahead of pace. So I need to reset the new goal. But so that's really kind of the driving factor for us, is that it's kind of how we measure it here. But really, it's the, we go back to, our investors use us as part of their retirement. So they're trying to grow their nest egg, and they invest in us, and obviously we take that super seriously. I invest alongside every single deal as well. So you got my money in the deal, and we're all kind of pushing the same direction. And you really, and you're rewarded every once in a while with those, career phone calls when an investor calls you up and says now they can check the accredited box because they've been investing with you.
Yeah.
You helped them get to that level. So that was pretty bone chilling, or not bone chilling, skin. I don't know. I got goose. Yeah, there you go. It was a very heartwarming, really cool moment. And we've had that a few times with some of our investors, but that's a big driving factor as well.
It's really great. It's awesome. I love that there's people like you in the universe that are good stewards and fiduciaries and personable, which is new because you got to talk to people and they want to hear. And I think that's the coolest thing about any of the funds out there. It's like, it's not some mutual fund or this or that. You can't communicate with the person. It's like, let me call the fund manager, probably pick up the phone and
Right.
communicate. How do you, you work a lot of hours. How do you function in the week and talk to all these folks? Man.
Yeah, so we have a great team up here. We've got 17 employees now on the investment side, and then we own the management company as well. That's a whole bunch more other employees, but we have a president and CEO. She runs it. She's great. But up here, we keep hiring folks. We're growing pretty quick, and so we have an investment manager now. She's our concierge for our investors, or what we call it. And it's really putting out, we do monthly updates on their investments to them. They get a full financial package to kind of break down the numbers for them. And then we host a couple of conferences each time a year. We do a meetup here in Dallas as well every month. So we're still pretty active. I make sure myself that I'm available for our investors.
Amazing. I love it. Love the just statistical part of everything you're doing. That's, it's fun to be able to hedge based on hard facts and math and tangible real estate. So what's the easiest way to get a hold of you?
So the best way is through our website. So Wolfe with an E-investments.com. And then on there's a place to drop in your email. It's going to prompt you to set up a phone call or an in-person meeting here at our office in Plano, Texas. And then after that, we can get you on the investor portal. But that's the best way to contact us. And then I speak at a lot of events. I'm speaking tomorrow or this next week at the IMN conference in Laguna Beach. And then we host our own conferences 3 times a year too. So, but anyways, best way to contact us is through there. And then we're pretty active on social media as well. Facebook.
Yeah, your YouTube channel is all over the place.
Great.
I love it. Thank you so much for the interview. So we'll have you back before the end of the year when you hit $1 billion assets under management.
That sounds like a date.
For sure. All the best. Cheers. Thank you for being here.
Awesome. Thank you very much.
Real Estate Investor MBA. I'm Tejas. We just had Kenny Wolfe. Check out our website, Spotify, iTunes, Stitcher, all that stuff. Cheers.